Hello once again. Welcome to day 4. This is a continuous course about this topic about investment appraisal. I'm still Taimana Evarist, as you saw in my presentation. I'm a student from University of Rwanda in the College of Business. I'm studying business administration, honors finance. Below, this is my email. You can contact me, you can WhatsApp me for that phone number. Today, for day 3, let us proceed about tax on operating flows. Before going about that, let us remind you what you have seen in day 1. In day 1, we have seen introduction about this investment appraisal, where I introduced about what the meaning of free cash flow. In day 2, we had looked about the appraisal, where the project appraisal, where we deal with inflation, and we had collected an exercise, and everyone, I hope, was satisfied. Today's session, we are going to deal with taxation, tax on operating flow. What you have to know: corporation tax charged on a company's profit is a relevant cash flow for net present value purpose. Do you understand? The corporation, they have to pay tax. These tax are paying are from the relevant cash flows they receive. They can get tax allowance or tax deductible. So it assumes that operating cash inflow will be taxed at the corporation tax rate. Here in Rwanda, the tax rate is 30% for corporation profit, meaning that if the company gets inflow, they have to be taxed at the corporation tax rate. Another things, the cash inflow, the money comes in the company, they have to pay. The operating cash outflow will be tax deductible and attracts tax relief at the corporation tax rate. Here they say that the tax outflow, the expense company is going to make, meaning that they are going to be tax deducted at the rate of corporation tax. That tax is going to be deducted, not to be paid. The company is going to gain from that tax deduct. Tax is paid in the same year the related operating cash flow is earned, unless otherwise stated, meaning the tax is going to be paid the same year relating to that earnings the company gets, relating for that profit the company gets, unless otherwise stated. You can state if you are not paying tax, you can state it. If you are not stated, you are going to pay in the same year that revenue you earned. Investment spending attract capital or written down allowance, which get tax relief. Here they're saying that investment spending attract capital. If you take amount of money you are going to spend for buying an asset, that an asset is going to have the capital allowance or written down allowance, and this tax capital allowance is going to be tax relief. If we are saying tax relief is a tax benefit, you are going to benefit due to this investment spending. The company is earning net taxable profit overall. We are still about the dealing with the taxation. Capital allowance or written down allowance. For the tax purpose, we are going to deal about the capital allowance. Let us start. For the tax purposes, a business may not deduct the cost of an asset from its profit as depreciation in the way it does for financial accounting purpose. Here, they say that the business may not deduct the cost of an asset. They will not deduct from the profit as depreciation. It will be deducted as a capital allowance. Instead, the cost must be deducted in the form of capital or written allowance. As I said, the basic rules are the follow. When you are going to deduct that cost of an asset as depreciation, you are going to use the capital allowance, not using depreciation in that name. So there are rules you are going to proceed in order to get that written value. Written down value are calculated on reducing balances basis, usually at the rate of 25%. Written down is going to be calculated at reducing balance. The people who are from accounting, they know this well. You are using the reducing balance when you are calculating depreciation. I hope everyone is clear about this. Another things, they are said that the total written down allowances give over life of an asset adequate to their fall in the value over the period. The total written down allowance, they give the over the life of the asset. If you buy an asset, you are going to use it like in 5 years. You are going to calculate the written down value in that year. But there is something you have to remember. In the year where you are going to dispose of all that scrap value of an asset, the remaining value of that asset should be taxed or not taxed. Written down allowance are claimed as earlier as possible. It is claimed as earlier as possible. Written down allowances are gifts for every year of ownership except the year of disposal. Here they're saying that the written down allowances, they give for every year the ownership. You have to get that written down value in every year, in year 1, year 2. If you have an asset that have like 5 years useful life, you are going to get the written down value in year 1, then written down in year 2, written down value in year 3 up to year 4. But for year 5, where that you are going to dispose your asset should not be a written down value. In the year of the sales or scrap, a balancing allowance or charge arise. For the last year, you are going to sell your assets. You are going to remaining the balance. That balance is going to be paid tax or be allowance. So if they are saying to be allowance, we are going to be the tax relief. Going to be the tax relief, or you are going to get a charge. Meaning here, if you sell your asset and that asset you get a profit, you are going to pay tax. If you sell that asset and you get a loss, you are going to get allowance. Meaning if you get a loss, that is an expense. Expense not taxed. For CPA students, they know this very well. And you have to know, because I'm here as a student from Iqbal, I'm doing the CPA. I'm going to help you to understand clear. Here, for dealing with the written down value allowance, I have we have to look about this is what you are going to use. So for dealing, you have original cost of an asset. You have the amount of that asset, the cost. Then you have to less cumulative capital allowance claimed. Here I'm going to give you an example. If that asset is about is equal to 1,000 USA dollar, and the capital allowance rate is 25, meaning that you are going to take the original cost of assets, you multiply with the 25%. That value is going to be deducted from the cost. What the remaining is the written value of an asset. Assume this was year 1. They was having the useful life of 2 years, meaning that in year 1 you are going to make it, you are going to take the ordinary cost minus cumulative capital allowance claimed, then you get the written down value of the asset. In year 2 you are going to dispose of that asset. If you dispose, you get amount of money. You are going to deduct that amount of money you disposed. Then after deduct that disposed value from written down value, you get balancing allowance or charge. You can get minus or positive. If you get a minus, meaning that the written value was less than the disposal. Here, if you get a positive, meaning that you get a profit. If you get a profit, you're going to be charged. If you get a negative, you are going to get tax allowance. If it is specified that load relating to written down value change, it should be required to take into account changes, to examine the impact of project of potential changes in the load. For example, we are going to deal about written down value. So, for example, giving a 50% written down value in the first year of ownership and 25 thereafter. In the first year, it is a 50% written down value, and after will be 25. Giving 100% first year allowance. These are some time available to encourage investment in certain area or types of assets. Changing the calculation method from reducing balance straight line. You can using straight line method to get this written value. Here we are saying about when the written value was changed. We are still about dealing with taxation in our project. In the project appraisal, the effect of taxation must be taken into account when you are calculating the free cash flow to be discounted. Okay, thank you for today. But let us look for an example where we are going to calculate the written down value, and also we look this project is worthwhile. An exercise. A company buys an asset for $26,000. It will be used on the project for 3 years, after which it will be disposed of on final days of year 3. Tax is payable at the 30%, and the capital allowance are available at 25%, reducing balance. Calculate the written down value and hence the tax saving for each year it's if the proceeds on disposal of the assets are $12,500. B. If a net trading income from the project is $16,000 per year and the cost of capital is 8%, calculate the free cash flow and hence the net present value of the project. So let us correct this question first. What we have looked previously, we have looked about how to deal with taxation. In a previous video for day 1, I have introduced and telling about how to get the free cash flow. For free cash flow, we take revenue minus cost minus investment. So in our question, we have data given. We have the cost of an assets. It is $26,000, and also useful life is 3 years because this asset is going to be used in 3 years. The tax payable rate is 30% and tax allowance is 25%. Let us go to the working down value allowance. This is the working one. We have time where we are going to look about the times year 0, year 1, year 2. For year 3, we are going to dispose our assets. Another data given, the disposal value is $12,500. It is another data they give. For working one, we have balances 26,000. This was the cost written down value at the beginning. So we are going to calculate the 25 as a written value rate. And when we calculate 25, we get 26. We get 6,500. That is accumulated as we have found in our formula. Meaning that we are going to take 25. We are going to take $26,000 raise accumulated written down value allowance, which is equal to 6,500, and we are going to get 19,500 USA dollar. This is a written down value for year 1. Let's go to the year 2. Year 2 written value will be, meaning that in year 1 that written value we get will be the remaining the cost of assets. So we are going to take that cost minus another accumulated in year 2, where we are going to take 19,500 times 25% as a rate of written value, and then that will be the accumulated. We less it, that accumulated equal to 4,875. So we are going to take the written down value from year 1, which is equal to 19,500, raise 4,875. We get the written, we get the value in year 2, which is the written down value. So in our question they said that they disposed our asset in the final year. The final year was year 3. Remember, when we were studying about how to deal with taxation, we said that for calculating the written down value, we calculate each year written value except the year of disposal. if you disposed an asset in final year, you are going to get the charged value or balancing allowance. So for year 3, we dispose our assets at 12,500. That is the amount of money we received when we are disposing. And remember, our asset in year 2, the remaining balance was 14, which is the written value, 14 and 625. That is the written value in year 2, that remaining. So we are going to take this written value, which is equal 14 and 625, and we raise the value of sales proceed, which was equal to 12,500 and 500. You see, we sell our assets at 12 and 500, meaning we get a loss. If we get this loss, is not going to be taxed. Our loss we get is 2,125. This value is not going to be taxed. It's going to be balancing allowance. This is called tax allowance. So for tax saving, meaning that value of for let us start for year 1 to get the tax saving. You remember the 25% of the cost of initial investment was 6,500. So we are going to calculate for the tax. So tax was 30%, meaning that accumulated weight and value, you are going to take 6,500 times 30% to get the tax saving in year 1. For year 2, you are going also to get accumulated written down value, which is equal to 4,875 times 30%, and you get 1,463. For year 3, remember, we get a loss. We sell our assets and we get a loss of 2,125. So we get, and this loss we get, we are going to get the tax saving, where you take 2,125 times 30%, where we get the 637.5, and approximately 638. So this is for A. Remember to subscribe for our channel, and God bless you. We shall deal for the required for B, where we are going to calculate the net present value, and we get this project is worthwhile. Thank you very much. For this is the session for today. We'll proceed tomorrow, meaning that you have subscribe and share for others, and remember